You sold a business, you have a ton of cash, and you have no idea what to do with it. You know you need to invest it, but you don't really know exactly where and in what to invest in, and really just the differences in all of the different types of investments that are out there. I'm Raul Shah. I'm the CEO of DocShah Financial. We are a wealth management practice, and I'm going to explain to you all of the different types of investments for you in this video. The slides you're seeing are directly from the retirement planning course that I teach at Johns Hopkins University, which is also my alma mater. Now, before you say retirement planning course, relax. The slides here are specifically for understanding the types of investments, which is part of a retirement planning course, even though a lot of the course focuses on tax planning strategies, which is a lot of the videos on this channel. We're going to start here on the left side of the screen with stocks. This is something that you're probably very likely familiar with. A lot of you watching probably have a brokerage account, Schwab, Fidelity, E-Trade, Robinhood, and you have probably dabbled in buying individual stocks before. The key to understanding what a stock is that it is an equity claim. Equity meaning ownership. It's an ownership stake in a publicly traded company. That means that whatever the company makes in profits, you are entitled to your share of ownership of those profits. So if you own 10% of a company, you have a claim on 10% of the profits in that company. Now, I'm going to keep using the word ownership because it's very important. When you own shares in a company, you own part of that company, which means if that company goes to zero, your shares are worth zero. And if that company continues to rise higher and higher, well, then your share value will rise higher and higher. There's more risk when you're buying individual stocks because of what I just said. Your investment could go to zero if you buy a really lousy company. Most people, when they're buying stocks, they're just looking at the stock price, they're looking at the news, they're not actually looking at the fundamental value of the business. That's why most people lose money on their investments. It's not that buying individual stocks is something that you should necessarily avoid. It's that likely the strategy you're using behind buying those individual stocks is highly flawed. But that's what stocks are. They're ownership claims in a company that have a lot of potential upside, but they do have more risk because they could go to zero, leaving you with a bankrupt investment. Now, if we slide to the right, we have what are called bonds. Bonds are called fixed income assets. They are not ownership claims. A bond is just an IOU. It is a contract to get repaid in dollars. Anybody can write a bond. I could write a bond for my neighbor. Maybe my neighbor wants to buy a new car and he needs to borrow some money. He goes to the bank says, okay, we'll lend you money at 7%. And he says, oh, that's too high. And he comes to me. I could write him a bond and lend him money for 5%. It's just a contract to get repaid in dollars at some point in the future. It is a loan. Individuals make loans to all kinds of entities. When you buy government bonds, you're loaning money to the US government. When you buy municipal bonds, you're loaning money to your state and local government. When you buy corporate bonds, like a bond for Apple, you're loaning money to Apple. The key difference between bonds and stocks is that in a bond, you do not own shares in Apple. You have only lent money to Apple, and Apple has promised you to repay you interest, and then ultimately, after a set period of time, say 10 years, they'll give you back your principal, which is what the initial amount that you gave them was. Bondholders have what's called senior claim. So in the event that Apple or some other company goes bankrupt, bondholders get paid first, and if there's anything left, stockholders get paid second. Again, going back to the point that stockholders have more risk than bondholders. But with bonds, you don't make as much money. The upside is essentially capped. You have a set interest rate most of the time that you know you're going to collect. Generally, nowadays, is not very high. You might get 4, 5, 6%, depending on who is on the other side of the trade, if it's a corporation or a state government or the US federal government. So you don't have as much upside, but you don't have as much downside necessarily. Now, if you loan money to a company that's going bankrupt, you're not going to get your money back. But if you loan money to the US government, it's guaranteed by the US government, they will pay you your money back. So you don't have that risk of not getting repaid. Now, if we go to the bottom left, we've got exchange traded funds, and the bottom right, we've got mutual funds. First of all, ETFs might own all stocks. It could be a mix of stocks and bonds. Mutual funds are a mix of stocks and bonds. The main difference between ETFs and mutual funds is that ETFs are exchange traded funds, meaning that they are traded on an exchange like a stock, so you can buy and sell them throughout the day. Mutual funds are only priced once at the end of the day after market close, so after 4 p.m. I'm going to talk about exchanges in just a second, but those are the 4 main types of investments: stocks, ownership, bonds, lending, ETFs, and mutual funds. Those are the core 4, as we say. And when we're building portfolios for clients, we're always trying to strike a balance between risk reward and also your individual goals and what you want to get out of your portfolio. Some people have a higher risk tolerance and a higher risk capacity, and so we're more aggressive in those portfolios, and there's a higher percentage of individual stocks. Some clients don't have that luxury of having a higher risk capacity, and maybe they're also more risk averse, so we own more fixed income assets or more bonds or mutual funds. Now I'm going to take a look at the right side of the screen here and just kind of quickly walk you through some of the different types of investments that are out there. The first one is we have cash or CDs or savings account. This is money you put in your bank and you earn a very nominal rate of interest, and it's just kind of basically sitting in cash, but you're earning a little bit of interest for leaving your money there. CDs or certificates of deposits are just bank deposits that pay you a little bit of interest for locking up your money for a set amount of time. Treasuries are bonds issued by the US government. TIPS are inflation protected securities issued by the US government. Commodities are like gold and silver or wheat that investors trade to try and make a profit. Annuities are simply just insurance contracts that generally promise to pay out a set or guaranteed amount for life. REITs are stocks, but they're real estate investment trusts. REITs are essentially a way to own real estate without actually owning the real estate. You're just owning a claim to the rental income. So people who want real estate exposure tend to like REITs. A lot of retirees like REITs as well because they pay regular dividends. And then we got miscellaneous types of investments like derivatives or other forms of alternative investments. Now, if we want to categorize the investments, right, I've kind of explained to you what they are, but let's try to slice it up a different way so that we can really understand what the different types of investments are. Let's look at ownership. In ownership, you've got stocks, REITs, and private equity. You have an ownership claim in those businesses if you own one of those three. We've got lending, which is primarily just bonds. Remember, a bond is a contract to get repaid in dollars. It's a fixed income asset. We've got US bonds and treasuries and TIPS. We've got corporate bonds. We've got municipal bonds. Then we've got cash and cash equivalents. That includes money market funds or certificates of deposits or your savings account. Money market funds, by the way, are a special type of mutual fund that own primarily fixed income assets of very short durations, so 1 year or less. We've got pooled vehicles like ETFs, mutual funds, hedge funds, and then we've got alternatives like commodities, options, and I put annuities there, although that's really more insurance than it is in alternative. Now let's go to the bottom right corner of the screen. This is what I really want you to think about and really hone this down. Stocks, you own the business. Bonds, you lend the money. REITs, you own the rent. Mutual funds and ETFs are a basket of investments. Commodities are ownership of physical goods. So there you have it. Those are the types of investments. Now I got a bonus slide for you too. Remember, I promised to explain to you what exchanges are. So first, I want to point you to the left side of the screen, which is index. An index is just a grouping of stocks. If I wanted to, I could go find every company whose CEO is left-handed and call it the left-handed index, right? It's just a grouping of stocks. That's all an index is. The ones that you're likely familiar with are the S&P 500. It's 500 of the biggest US companies. We've also got the NASDAQ, which is another index. It's mostly tech and AI stocks. But an index, think of it as just a grouping of like securities. An exchange, on the other hand, as you see on the right side of the screen, is where individual securities are actually traded. An exchange is a place. It's not a grouping of anything. It's a physical place or electronic where actual trading happens. The main example of this is the New York Stock Exchange. In fact, I was interviewed by Charles Schwab at the exchange, and we'll put a little screenshot of that up on the screen. The one that really trips people up is the NASDAQ, because the NASDAQ is an index, but it's also an exchange, so it's actually both. A lot of people will get that confused, so hopefully that clears up the error a little bit. Now, there's a million ways that we can analyze stocks, and that's beyond the scope of this video. But if you're interested in how I build stock portfolios for clients, and you want to put that money that you've gotten out to good use and create a really solid portfolio for future growth and that meets your ultimate goals and what you want out of life, shoot me an email, Raul@DocShahFinancial.com. I'd love to hear from you and your personal situation and how I can help. Otherwise, I hope you learned something. Subscribe, and I'll see you in the next video.